Asset finance. Asset finance gives your business access to asset-based needs to move forward without depleting cash reserves better invested elsewhere. It is a broad term that refers to a range of solutions. Generally, however, its primary purposes can be categorized in two ways: help a business get additional assets and release a loan secured against a business's existing assets. Asset finance without cash release. Businesses are regularly confronted with a difficult decision on whether to buy an item to upgrade performance. This involves gauging the long-term benefits of making the purchases against paying for the upfront cost that may compromise cash flow. Decision-making often ends with delaying that needed purchase and passing up on an opportunity, which doesn't have to be the case. Asset finance helps you spread the cost in investing for workspace, equipment, vehicles and other needed revenue-boosting technologies in short to medium-term period. This can be further divided into more specific approaches through finance lease, hire purchase contract, operating lease and asset refinancing/commercial loan. Finance lease. The lender buys the needed item on your behalf. You pay back the lender in a few months, but the item can already be registered on your balance sheet as both an asset and a liability at the start of the repayment agreement. This way, you can take advantage of tax perks accorded to owners of machinery. You are held responsible for maintaining and insuring the asset throughout the term. Hire purchase contract. You repay the lender who buys the item C, after which you are given the option to purchase the asset for a small sum. During the entire repayment term, the full value of the asset appears on the lessee's balance sheet as an asset and liability, and an element of the rental treated as a business expense. Operating lease. The lender also buys your needed item, but it is only leased to you. This is an excellent option when you need an expensive item that is not usually offered in the market for leasing, but you don't also intend to buy and use longer than after the repayment period. In most contracts, you are responsible for the maintenance. But once the lender takes back the asset at the end of the agreement, the maintenance obligation resides with the lessee. The item, being rented for a pre-agreed term, does not appear on your balance sheet as a liability, rather an expense. Asset refinancing or commercial loan. Asset refinancing for business refers to the use of a company's assets as security to obtain a loan. Assets pledgeable as collateral can range from accounts receivable, inventory, equipment and buildings. Asset refinancing can also be combined with other financing approaches. For instance, you bought a $10,000 worth vehicle based on a hire agreement wherein you own a sixth of it while the lender owns the remaining portion. If in the future you want to own the vehicle, you can buy the lender's stake through getting finance from an asset refinancing provider. How to apply and secure approval. Lenders look at your credit history and growth prospects to check your ability to make repayments. The life of the asset finance contract can stretch up to 5 years and repayment is made monthly. However, some lenders are more flexible than others in adjusting repayment schedules, an arrangement most beneficial to businesses that generate revenue on a seasonal basis. The size of lending varies depending on your type of business, but the size across United Kingdom-based providers range from £5,000 to £1 million can be financed. Some alternative providers allow online applications for more convenience and can often translate to same-day decisions. Finance tips. Here are some things to know and consider before applying for asset finance. There are tax perks when you buy or lease an asset. The kinds of incentives you can enjoy depend on the type of asset purchased and whether you purchase the assets outright or on an installment basis. This also affects whether VAT will be charged upfront or periodically. Renting or leasing an asset is considered an expense and, as such, can help reduce your tax bill. If you are VAT registered, you can reclaim VAT paid for assets if used for business purposes. You can also claim capital allowances, proportion of the cost from your taxable profits each year, if the equipment is bought outright, through hire purchase or supplied under a long funding lease. You might be paying a much higher cost than when purchasing the item on a one-time payment. As mentioned, there are several fees associated with asset finance. If cash reserves are sufficient, paying for the upfront cost is the much preferred route if you think you will be using the asset in the long term. Some merchants even offer small discounts when you pay for an item in full. A detailed calculation is critical in coming up with the right decisions. How technology affects depreciation of items. It's better to lease items that depreciate fast, especially if the market demand for the item declines after 5 years. Technology plays a significant role in this determination of an item's market value. As such, industries that are easily penetrated of technological disruptions are more exposed to fast depreciating assets. Some require a deposit or advanced payment. Some lenders require this to reduce risk. There are no penalties once you default in your payment, but if you default, you lose the equipment to the lender who will resell it to recoup the debt. This is a big drawback to those who expect to have the asset under their possession by the end of the contract. However, for lessees with no plans of acquiring the asset, there will be no impact on cash flow since you only pay for what you need. Provided a competitive and flexible finance package. All in all, would certainly do it this way again.